Welcome to the risk control training module. Risk control is very important. In fact, without proper risk control, nothing else you do in Forex trading will matter. Nothing. Let's explore an example of improper risk control. If you start off with an account, say $5,000, you've got a $5,000 account ready to trade Forex, you're excited, you jump into a trade, and the trade is risking $2,500. You should hear a big buzzer go off in your head that goes, bad trading idea. Bad trading idea. BTA, as we call them. If you do this, this means basically that it only takes 2 consecutive trades to take you completely out of the game. Our objective is not to be taken out of the game. Our objective is to set up a solid foundation and be able to survive the times when our trading methodologies aren't exactly in sync with the market, and we end up having the inevitable losing trade, or trades for that matter. 2 consecutive trades, 3 consecutive losing trades. These are not unusual in Forex trading. And wrap your mind around that, because losses are a natural part of it. We'll talk more about losses as we go through live examples as well. Okay, so here we are in MetaTrader. We've got everything set up. We're talking about risk control. Okay, so what do we do to control our risk? Great question. What we do to control our risk is first determined by the trading system that we're using. Now, conservatively, many suggest that you risk between 1 and 3% of your available capital per trade. So, say we're in this screen and we're looking to trade the euro dollar US dollar, and we have $5,000 we're using as a standard here in this particular case in our account. So on one side of that, 3% would be $150. So what does that mean in terms of market movement? That's very important. So this is what we're going to do. We're going to go up to the 1-hour chart here, and we're going to maximize that chart. Then we're going to go up and we're going to zoom in just one touch. And you'll notice that now that we've maximized this chart, the other charts are maximized too, weekly and so forth. Okay? All right. Now, as a for instance, let's take a look at the weekly chart. And let's click on the zoom in here. I'll wait one moment while you do that on your chart. What we'd like to look at is market movement. We're looking at a candlestick chart setup here, and we want to look at market movement in order to get a feel for the types of risks in the different time frames. This is very important because, well, if we're risking 3%, we're risking $150. Well, quite naturally, we couldn't use a standard lot size of $10 per pip in the euro dollar US dollar, because, well, I guess we could, but that would be not very many as far as pips is concerned. It'd be a small move, in other words, basically. So we're talking about 15 pips, and giving the market 15 pips of room to move that's a scalping kind of setup. And if we're doing scalping and the trading system that works for it, then that's fine. But if we're looking for time frames, we're trying to evaluate which time frame we should trade in. And let me hold on one moment and clarify why I'm talking about time frames. Because the larger the time frame, like the weekly being the largest time frame here in our set of charts, the more room the market will need to move in order for it to go through its natural gyrations. Now, I'm going to pop here and we're going to go into custom indicators, and we're going to scroll down to ATR. And I'm just going to set that at 10. So set yours at 10 as well. Okay, what's going to pop up is this blue line down here. If you want to, we can make that blue line a little thicker, if I'm not mistaken. Will it give us an opportunity to do that? Yes, it will. Here we go. Hold on. Okay. Colors. Doesn't look like it's going to give us an opportunity to make that thicker. That's okay. This is fine for our purposes. We'll take a look at the blue line then. Okay. So let's take a look at the values here as we're looking around. In fact, let's go up here, click on data window, and you'll see that our ATR, our average true range, is listed right here as we scroll along each of these weekly prices. Now, the average true range is the average of the true range. And the true range is described as the greatest of one of the three of the following: the difference between the current high and the current low, and that's commonly called simply the range; the difference between the current high and the previous close, or the difference between the current low and the previous close. Whichever one of those is greatest is the value that we'll get. Now let's take a look. Okay, we're on the weekly chart, and we're looking at the average true range. And as you can see over here, 0.0252. And if we look at that, that's 252 pips. That one, 256 pips. 257. Again, we're looking at the average. If we come down to places like this, you see how big those ranges are. And over here, almost 600 pips. Big, very big. And that's, again, that's an average. So this is obviously going to be bigger than that, but we're averaging in those previous true ranges as well. You can see from this example that if you're trading on weekly charts, that you're going to need room for the market to move. Now, there's a few ways you can do this and give the market room, but with a $5,000 account, trying to trade a standard lot with a 15 pip stop is not going to work very well. It's not going to work very well. So what we're going to do here is let's go to a daily chart, for instance, and let's expand that. Okay, auto scroll brings us back, and let's do the same thing there. Let's go down and grab our average true range. We'll do 10 period. There we go. What are we looking at here? Okay. We're looking at some smaller numbers here. Looking at some smaller numbers, but we're still looking at the 100 plus pip range, not the 15 pip range. You can see that's really something. So that's 100, 100, 100, 100. Okay. So let's move on to the next time frame. And we'll pull this down to ATR. Okay, here we go. Click on OK. I'm going to click that to expand that a bit. Okay. All right. There we go. We're looking at 60, 50. That's a big one there. Again, these are averages. 40. Okay, so this is looking a lot more reasonable for the type of trading we're talking about with regard to the type of risk control that we need. But this would still, even the 4-hour would be too much for trading a standard contract with a $5,000 account with a 15 pip stop. Again, adhering to the 3% rule. So we're going to move down to 1 hour, and we'll do the same thing as we did before. ATR. And I'm simply changing this to 10 periods for the sake of consistency here. Okay. All right, you see much more reasonable ATRs here. Okay, and the ranges perhaps that we're talking about, still not giving us much buffer room as far as that's concerned. But at least we see how the different time frames show us different ranges of price movement per bar. So let's close this down. Close down this window. And go back here. Now let's say that the trading system that we've chosen does use daily charts, and we want to trade using the daily charts. But we see the sizes of some of those moves as we move along here. There's a few ways that we can control our risk. It depends on what the system is and what it dictates as far as the price movement is concerned. So for instance, if we are trading a daily system and the system has a stop loss of 100 pips, then we quite obviously can't use a standard contract for that, because that would mean that that 100 pip risk that we're taking would end up being the 100 times the $10 per full size pip. So that'd be $1,000. That $1,000 would be 1/5 or 20% of the total $5,000. And that would be too great of a risk per trade. So what we'll do is we'll trade the daily chart, but what we'll have to do is we'll have to scale our level of leverage as far as volume is concerned. So rather than going with one full-size contract, if for instance we went to something that was 1/10 of that size for our 100 pip stop, then it would put us right inside of our 3%. So let's go over the logic in this. The trading system, the one that is our virtual imaginary trading system that we're saying that we'd like to trade, uses daily charts and uses a 100 pip stop. We can't trade that using a standard size contract because it wouldn't take very many consecutive losing trades in order for us to blow our account completely out of the water. So what we do is the smart thing, and we scale down in order to still trade on the daily chart by giving the system the necessary amount of room. So rather than risking the $1,000 per trade, we're risking $100 per trade by setting ourselves up in this fashion. So the $100 per trade turns out to be 2% of our total account equity at the start of trading. This is fine. We're able to do that. We're able to trade on a larger time frame chart, be it daily, be it weekly, as long as we're inside of our risk parameters, not going outside of that 3% of account equity. Some people will go to 5, and actually the higher the percentage of your account equity you risk per trade, the greater probability of blowing your account out, the greater your risk of ruin, basically. Some people call that ROR. But as you can see here, we can control our risk with virtually any account size as long as the broker that you're using allows flexibility in the size of the trades that you place. And as it turns out, we have good flexibility here in the size of the trades that we place. So that's good. That's good to know. I'm going to set this back to the standard. But that's basically some risk control guidelines in a nutshell. Now, if you go to smaller time frames, if say, let's pop this up, and let's pop, we're going to do that, and we're going to do this, and we're going to do this. Okay. All right. Now, we're looking at an extremely short time frame here. This is 5 minutes. Many people do scalp, and scalping is defined as grabbing a small number of pips, and small is relative, but for instance, 100 pips is not a scalp. So 100 pips profit is not a scalp by any stretch of the imagination. 100 pips is bigger than a scalp. 5, 10, 3, 7, 12 pips, that's scalping. So in here, as we're moving along, if you take a look here, if you're trading on a short time frame, small time frame, then as you look over to the ATR window there, you look at, we can look here too, you can see 11, 10, 10. So the market moves in a smaller range in a smaller time frame. So you can trade on a chart of this type of time frame and allow the market room to move with a smaller number of pips. See, the objective is to be able to have a trade go profitably and not come back and knock us out of the trade by hitting our risk control measures. So we have to have enough room in there for the trade to move without just the regular noise of the market knocking us out of trades. We don't want to set our stop loss which is our risk. This is the amount that we're risking, and say it's 100 pips for a certain type of chart. On a daily chart, if we set our stop loss to 1 pip, we would just get stopped out over and over and over and over and over and over again. So that makes a stop of that magnitude for that time frame pointless. So let's go back here to hourly, close the data window. That is a brief introduction to risk control, also an introduction to the wonderful scalability of Forex, which allows us to trade different lot sizes based upon the risk control that we need for our particular account size. Thank you very much for joining us in this module, and I hope you found this to be very, very helpful. Let me emphasize again that the most important thing you can do is to get control of your risk. Once you get control of your risk and you have the discipline to continue to control your risk, you will be miles ahead of Forex traders worldwide. Thanks again. Hello and welcome to our first actual trade example, just to show you how trading works here inside of MetaTrader. Okay, we're going to pop up here, and what I'm actually going to do is I want to sell. This is basically, just consider this to be a random trade to show you the order process. I want to sell here, but what I want to do is I want to place a stop up here above the previous week's high. Let's find out what that was. The previous week's high was 1.50598. So I'm going to place a short order. I'm going to sell, and I'm going to place a stop up above that high, 5 pips in fact above that high. Okay, so placing that 5 pips above would be 1.50648. So this is what we're going to do. Going to place a new order, and I'm going to sell at the market. And since we're using a certain size of an account, if I were to use the standard size, then that stop would be out of reach. So what I'm going to do here is I am going to use this size. Okay. You can see that I'm moving the stop over here, just so you'll see. Now, here's another way to do that. You can simply type that in. 50598. Sorry about that. 50648. That's what we're actually after. Okay. Instant execution, comment. And the comment here is first live trade example. Placing an order. Okay. Like to have, oh, that's all the that's all it let me do there. Okay, so live trading example, first live trading example, and here we go. I'm going to sell at the market. Oh, there we go. It says successful. I'm going to press OK. And you can see from up here that we are officially short. And let's go down here to account history. Mailbox trade. Okay. We are short from this price, 1.48388, around here. There's our stop loss. We don't have a price target in currently. You could see how this is moving. If this was a full-size contract, it'd be moving further against us, but it is not, so we're okay. So we're moving along quite fine. Okay, so here's a way to determine range too when you're looking for places to set your stops. You go to ATR down here, go to your indicator list. There's ATR, and set that period to 1, like so. You see the previous week, the average true range is 233 pips. So that's actually a pretty small range. You see that the current week, it's 380 pips. And this is just on this particular, we're just talking about this particular bar right here. And in fact, if you go over to, let's put it here, this area here, and subtract the low from the high, that's the number that you'll get. That verifies that that's the range. What that number lets you know is the simple range from the high to the low. And that range is important because if you're trading based upon that range and you're saying, okay, I want my stop based upon price action, so when if the market moves back up here and breaks the highest high, then I want to be out because the momentum has shifted from downward to upward. Now this is a big time frame. Weekly is a big time frame for anyone to trade. That's why we've scaled ourselves correctly to this particular size. And as you can see, even though the market's moved against us, hasn't cost us very much, has it? Has not cost us very much. And that's the whole point of doing this particular exercise, giving you a feel for risk control, how to find out the range of the particular market that you're trading too. That's always important. And then you have an opportunity to measure things like risk reward. So if you're measuring risk reward, you might look at this and say, okay, look, here we are. We're right here. I'm risking 233 pips. And you might say, I like a 1-to-1, or I like to risk 233 pips to make twice as much, to make 466 pips. So you'd place a profit target down here. Again, we don't have an exit already set up because this is a simple trade entry example, and that's it. Okay, we're back, and as you can see, the market has moved against us somewhat. If this were standard, we'd be looking at a larger loss, 10 times that amount, or $100, which is nothing to be shaking in our boots about, of course. So this is what we'll do. We're having a good time in a live trading example, so let's put in a profit target. What I'll show you how to do here is to take your order and modify it. And we'll add a profit target here. So if we're looking at risking roughly 233 pips or so, then let's make our profit Make our profit 466 pips. So if we go below, I'm going to base this on our entry point, 43728. Okay. So we're going to modify that, take profit, and click modify. All right. Okay, we sell at that, which we're already in. Stop loss is set. Take profit is there. Let's go OK. There we go. This shows our take profit point, which is right down here. Not exactly close, but we're looking at something that's twice the size of what we're risking here. So if you look at that, the distance from the entry to the stop, this is twice the size of that. And again, for the purposes of example. So what we're going to do is we're going to let this trade develop. I'm going to close our data window here. And I'm going to take a look at the trade on a smaller time frame. Okay, we don't have to watch our price down here constantly, but we can if we want to. We can bunch this up a little bit. Okay, so it's good to see where our stop loss is. You can see our stop loss is just above the high action here, back about a week ago or so. So we're here, and we sold right here, which was right at a previous high. Now, if it does break through and go up, then we've got potential previous high. It may go up to here before we encounter some slowdown in the trade, some resistance, and we'll have an opportunity to talk about support and resistance as well. Okay, the auto scroll pops back. So you can see here the market is continuing to move up past our entry here. So we're going to leave this and we'll come back to it and we'll see how this trade develops, and we'll have an opportunity to do a lot more live examples. Of course, this is our first live trade. It's our first sort of jumping in there example. There are no methods for anyone to copy or emulate. This is an example only. So we'll see you in the very next module with an update on the current trade. Okay, here we are back at our live trade example, and as before, we were short the euro dollar US dollar. And let's take a look at where we are today. And this is the very next day. We're up 123 pips. So in this case, we're using a lot size of 0.1 rather than 1 in a standard account. In a standard account, this would be, our standard lot would be $1,237 basically. So 123 pips would be $1,230. That's how far we'd be ahead in this particular trade. Okay, so let's go down here, take a look at modifying our order here. Now we can get out here, or we can stay in here. We have a couple of different choices. And again, this is an example trade. So I'd like for you to see an example of getting out of a trade at a profit. What we're going to do is I'm going to expand here so you can see the move that has been made from our short entry. Market did go up, move against us, came to our favor, came back up, and then proceeded downward from there. Okay, so here we go. Without further ado, let's get out of this trade. Modify, delete order. Okay, we're going to close this out. So put instant execution. I'm going to close the sell out. And more, the market's still moving down. So here we go. All right, that's it. Now, as you'll see, that trade's completely closed out. Let's go back over here. And this is something that you always check. There's no profit target line. There's no stop loss line. So there are no pending orders. That is a good thing. That's exactly what we want. The order here canceled out the stop loss, canceled out the take profit, and closed at 1.47134. This means our profit on this particular trade was $125 because we're using a 1/10 lot size, standard lot size, in a standard account that would have been 125 times $10 per pip, which would have been $1,250, which is fine. Now, there may be people out there thinking, well, why in the world didn't we go for that $1,250? And the reason is that going for that $1,250 would have required a larger than reasonable amount of risk. That would have required that rather than our stop be $233, that our stop up above this point here on this weekly chart would have been $2,330. That's almost 50% of our initial equity. And here we can see all the things here from our trade, the details. 120, a little bit over 125 pips. So we're happy with that. That's a very, very, very simplified example of a complete Forex trade. Now we're going to have more examples. Do not worry about that. Examples you can follow along with. You can place the same trades in your charts, which I would actually prefer that you do so that you can see everything that's going on. Now, one additional thing that I'd like for you to do is to, on your chart, I've already done it here, is to create a monthly chart to add to our particular profile here. Okay, now I can close this chart and I'll show you how to create it on your own. Okay, we go up here, new chart. Okay, you see it's our standard chart there. We're going to go to templates, go to candlesticks 1, and there you go. And we go up here, hit the plus sign, make that a little bit bigger for us. You can see that's still hourly, so we go up here to monthly to complete a longer time frame, and there we have a nice beautiful monthly candlestick chart. Okay, so we can easily hide that behind the ones we look at more regularly, or we can go up here and say we're going to tile them horizontally, hourly and 4-hour, and daily, weekly, and monthly, which is fine. We can do it in this way. And each of these, of course, when we want to look at them, we can just go and look at them on a larger scale no problem at all. So now this is what we're looking at. I wanted to include the larger time frame of monthly just to give us some additional perspective and really go top down. Monthly, weekly, daily, hourly, 4 hours, hourly. Got ahead of myself there. So does this mean that we're not going to look at shorter time frames? No, doesn't mean that at all. We are going to look at some shorter time frames, and we can set those up. In fact, any of these can be set up to be a shorter time frame. For instance, we could easily do this. Okay, that's saved as that. So let's just say we want to create another profile. Let's see. One moment. I like to keep the profile names consistent. Okay, we want to name that candlesticks, but we want to make it candlesticks and then call it candlesticks intraday. So that's what I want to do. Save EURUSD candlesticks intraday and put it as 1. Okay, intraday 1, because most likely we'll have more than one particular type of candlestick chart. And we save that profile. Go back over here. Okay, I didn't save this particular one from the last time. That was our monthly. That was my fault. So go back to the monthly and expand it. Okay. You can always hide it behind there if you wanted to. Or you can do something standard and then just go through and you're all set there. So we want to save that. And we're overriding the old one, basically. Yeah, we want to override it. So profiles, and let's go down to our candlesticks intraday. There we go. And here, all we have to do is change some time frames. So let's say we wanted to look at a 5-minute chart here. And a 15-minute chart there. Have to have an hourly chart everywhere. 4 hours. And down here, we're going to go with daily. Okay. So there we have that. Okay, so go back over here to profiles. Let's save as Euro dollar US dollar candlesticks intraday 1. And save that. Already exists. Okay, so now let's go back to our standard as we were looking at over here. Euro dollar US dollar candlesticks 1. And make sure it's set up. Yes, it's set up correctly. Okay, so now we've got a couple of different ways that we can work. I hadn't really put the ATR, the average true range, down here on this chart as we had in some of the others, because we weren't necessarily looking for the range of the month in particular, but we can always add that at any time we want. So our next thing that we're going to do is we're actually going to enter an additional trade. We're not going to do that now. So we're not going to make a trade example. What we're going to do is we are going to wait until Monday, and this is Friday, and it is about 4:12 p.m. Eastern Standard Time in the United States, and we're going to let the market do its thing, and we're going to come back on a fresh session and jump right into more trade examples. We're going to run into more indicators. You're going to be introduced into more indicators. We're going to talk more about trading without indicators. So there's tons of possibilities here. And basically, your objective is to learn to control risk, which is what you've seen in this particular example. And there's probably no one that's jumping up and down about making $125 for certain. But that's $125 that was made basically in one day on a $5,000 account while controlling our risk. And our risk was $233 at the time. So we've done a good job of getting into a profitable trade. We've managed that trade by managing our risks, and we've exited that trade. And in this particular case, we've exited the trade at a profit. Not all trades will be profitable. Let's not get disillusioned about that. Losses are a natural part of trading, and learning how to deal with them emotionally, psychologically, is extremely important. Because all through life, we're basically taught to have everything be perfect. In trading, things can be very profitable for you without them being perfect. Sometimes pretty far from perfect, actually. So trying to get 100% winners, I don't want to discourage anyone from that particular goal. Well, yes, I do, because it's a goal that doesn't make any sense. Most of the time when someone's looking for a high percentage of winners, it is because they are nervous about having losses. One reason that new traders are nervous about having losses is because the risk is not being controlled. For instance, in our previous trade, had we been trading a standard lot of $10 per pip, then risking that 233 pips times 10 would have been a big chunk of our initial equity. But by scaling it down and risking a small percentage of our account equity, we placed ourselves in a position to trade in a much more relaxed fashion. $233, if it had turned out to be a loser, it's not the end of the world. $2,330, it turned out to be a loser. Well, how many more times can we have a losing trade of that type? Well, one more time, and then we're no longer trading Forex. I hope that that makes sense. And I know I emphasize risk control, risk control, risk control, discipline, discipline, discipline. And I sound like a broken record, and that's good, because everyone else that you come into contact with in the Forex arena should be telling you the same thing. Control your risk. So this is what we've done, and we've ended up with a successful trade at this particular point in time. This one is a profitable trade, and we're going to look, as I said before, at a lot more exciting live examples, so you can see it where the rubber meets the road. I'll be placing the new orders here, and we'll just be chugging along. So I look forward to seeing you in the next module, where we're going to look for an entry point for our very next trade. Thank you very much.